Okay, let's unpack this. I mean, I want you to picture a number right now on the board. $40 trillion.
Yeah, it's a massive number.
Right, it's the exact size of the U.S. national debt today. But here is the part of the data that should really, make you sit up and pay attention. The interest alone on that debt is now over $1 trillion a year. And that's just to keep the lights on, not paying a single cent of the principal down.
It's a staggering figure when you break down the actual plumbing of it. I mean, that translates to roughly $3 billion a day.
$3 billion a day, wow.
Yeah, every single day. Just to service what is already owed, Washington has to find $3 billion.
And, well, that brings us to what we're looking at on the board right here at the BTG trading desk today.
Exactly.
We are mapping out this mechanism playing out in real time across global markets. It's what we are calling a silent reset.
And to be clear for everyone listening, this isn't some loud catastrophic market crash that makes the evening news.
No, not at all. Right. We are watching a quiet, methodical, three-step legislative and economic machine. Its entire purpose is to shrink that $40 trillion debt by intentionally melting the value of the dollar you hold in your pocket.
That's the gravity of this setup. And, to set the tone right out of the gate for this market brief, we are keeping this energetic, tight, and purely focused on the board.
Just the numbers.
Exactly. We are analyzing the mechanics. We are looking at exact market levels. And let me be crystal clear here. There is absolutely no buy or sell advice happening here.
Right. Then
we're only talking about the exact levels we're watching based on the live data in front of us.
Yeah, we're really just looking at the architecture of a system here. But to understand the silent reset, I think we have to start with the historical precedent.
For sure.
Because if you look back at the charts, we've actually been in a very similar macro environment before.
Yeah, we have. Currently, the U.S. debt to GDP ratio is sitting right around 123%.
This is wild.
Right. And the last time the country was anywhere near this level of leverage was right after World War II, when it hit about 106%.
And spoiler alert for anyone who, skipped macroeconomic history back in college, they didn't pay it off through austerity.
No, they didn't.
They didn't just aggressively balance the budget.
They never paid it off. What they did was shrink the burden of it.
Right.
So over the next 20 years, they brought that debt to GDP ratio down from 106% to 23%.
That's a huge drop. How did they actually do that?
The mechanism they used is something economists call financial repression. In plain English, they legally and artificially pinned interest rates below the rate of inflation. People thought they were doing their patriotic duty holding war bonds, but mathematically, they were taking a huge haircut.
I was actually thinking about how to visualize this earlier, and it's essentially like a landlord turning up a hidden thermostat in your apartment.
That's a really good way to put it.
Right. You have this block of ice sitting on your kitchen counter, and that represents your purchasing power, your savings.
Right.
You don't necessarily notice the heat turning up in the room, but day by day, that ice is melting. So by the time you actually reach for it to buy a house or a car or groceries, it's half its original size.
It's the silent tax, because that's exactly what financial repression is. If inflation is running at 5%, but your bank account is only legally allowed to pay you 2%, you are literally losing 3% of your wealth every single year.
Just bleeding out.
Exactly. And because the government owes a fixed amount of debt, the real value of their debt also shrinks by 3% every year.
Wow.
The saver pays off the national debt without a single new tax law ever being passed.
Okay, wait, I have to push back here, though, looking at today's board.
Sure, go ahead.
In the post-war era, things were entirely different. Today, the Federal Reserve is incredibly public. We watch their press conferences live. We dissect their dot plots constantly on the desk.
We do.
They publicly target a 2% inflation rate for price stability, and the market prices that in.
Right, that's the narrative.
So if they are openly promising 2%, how on earth can they sneak a higher inflation rate past the bond markets to melt the debt today?
Well, that brings us to move one of this silent reset machine. It's the intentional gap between words and reality.
Okay, explain that.
Publicly, the central bank states they won't tolerate inflation above 2%.
Right.
The markets hear that, it manages expectations, and it provides this, sense of stability. But look at their own internal projections. And more importantly, look at the real-world CPI data.
Yeah, their own projections have inflation sitting at 3.6%.
Exactly. And if you dig into the official government data, when you factor in things people actually buy every day, like shelter and energy, it's running north of 4%.
Which is double the target.
The words say 2%, but the reality on the ground is double that. So when 4% real inflation meets that $40 trillion debt, the debt quietly shrinks in real terms.
Right, because as long as inflation runs hotter than the average interest rate they pay on that debt, the debt just gets smaller.
That is the math.
So move one is basically the unannounced policy of a weak dollar. You say 2%, you run a 4%, and the gap is where the debt melts.
Spot on.
Which is exactly why the level we're watching on the desk today is the dollar index. We're looking at it sitting at 101 right now, grinding near multi-year lows.
Yep, 101.
And just to clarify for you listening, when we talk about the dollar index, or DXY, we're basically looking at the dollar's report card against a basket of other major global currencies like the euro and the yen.
Right.
At 101, it is showing structural weakness.
A structurally weak dollar is the policy. It just, doesn't get announced at a podium. We're watching that dollar index at 101 to see if it holds there or if it systematically continues to bleed out.
Okay, let's step into move two, because this is where the mechanics get absolutely fascinating.
This is the crazy part.
Right. If move one is inflation, well, that's only half the battle. Historically, if inflation runs hot, the free market demands much higher interest rates on government bonds to compensate for the risk of holding them. But if interest rates explode, that $1 trillion a year in current debt service becomes $2 trillion or $3 trillion, and the whole system mathematically collapses.
Breaks completely.
So how does Washington keep borrowing money without the bond market forcing interest rates into the stratosphere?
By creating a captive buyer by law.
A captive buyer.
Yes. And this is the piece almost nobody is connecting to the macro picture. You're looking at the Genius Act.
Okay, break that down for us.
Stripped of all the legislative jargon, this law does one specific, incredibly powerful thing for the U.S. Treasury.
Which is?
Every regulated dollar stablecoin issuer in America must back their digital tokens with real U.S. government debt. Treasuries.
Wow.
It's not a recommendation. By law, they have to buy U.S. debt to operate.
Okay, let me stop you right there and run the numbers because I'm looking at the stablecoin market cap on the board right now.
Sure.
The entire stablecoin market today is around $320 billion. You just told me the national debt is $40 trillion.
Yeah, $40 trillion.
320 billion against 40 trillion. I mean, that is a rounding error. It's a drop in the bucket. I'm struggling to see how this genuinely moves the needle for Washington's debt problem.
Well, if the market stayed at 320 billion, you'd be entirely right. But the scale of the plumbing and the catalyst that just dropped changed the math entirely.
I see.
The market projections show this specific sector is built to grow to $2 trillion by 2028.
$2 trillion?
Yes. And the catalyst happened on June 30th.
Right, the Open USD coalition.
Exactly. On June 30th, exactly 140 massive companies formed a coalition to build one single dollar token together on a unified standard.
That's massive.
We are not talking about small, volatile crypto startups here. We are talking about Visa, MasterCard, BlackRock, Google, IBM, Stripe.
The heavyweights.
140 of the biggest financial and tech heavyweights on the planet, all plugging into the exact same mandatory treasury buying machine.
Let's take an extra minute here to walk the listener through the life cycle of this yield machine, because the way it works is just brilliant.
It really is.
Put yourself in the driver's seat. You take one of your physical dollars and you convert it into a stablecoin to make a cross-border payment or buy an online asset.
Right.
Behind the scenes, the moment you do that, the stablecoin issuer takes your cash, hands it to the U.S. government, and receives a treasury bond in return, as required by the Genius Act.
Yep.
You, the user, earn exactly 0% interest on your digital token, but the issuer pockets the yield from that treasury bond.
Think about the near riskless income that generates. I mean, if an issuer has $100 billion in reserves, they're making $3 to $4 billion a year just from the interest the government pays on those treasuries.
That's incredible.
Everyone wins in this closed loop. You get the utility of a fast digital dollar. The tech companies get billions in free yield. And Washington.
Yeah, what does Washington get?
Washington gets a permanent captive buyer for its debt. A buyer locked in by statute, completely insensitive to price, and backed by the biggest tech companies in the world.
And we're already seeing this on the board. One single issuer already holds roughly $141 billion in treasuries.
Just let that sink in.
Yeah, $141 billion. That makes that one private company the 17th biggest holder of U.S. debt on Earth.
It's wild.
They hold more U.S. debt than most sovereign nations.
It completely rewires the global financial plumbing, which sets up move 3 on the board.
Right.
If you connect this to the bigger picture, you have inflation running at 4%, quietly melting the debt. and you have a legally mandated captive buyer keeping interest rates artificially manageable.
Okay.
Where does this inevitably lead the U.S. economy?
Well, it leads directly into the framework that's been heavily debated in macro circles lately, often referred to as the Mar-a-Lago Accord framework.
Exactly. And setting aside any partisan politics, because on this desk, we are purely looking at the economic mechanics and the flow of capital.
Just the numbers.
Right. The core thesis of this framework is that the U.S. dollar is currently massively overvalued on the world stage. The proposed structural solution is a managed, intentional 20 to 40% haircut on the dollar's value.
Let's explain the why and how behind that. Why would a government intentionally devalue its own currency by 30%?
It's all about trade.
Right. It comes down to closing the trade gap and pulling manufacturing back on shore. Let's say a company in Ohio makes a tractor and a company in Germany makes a tractor.
Okay.
If the U.S. dollar is incredibly strong, that Ohio tractor is far too expensive for anyone overseas to buy, and the German tractor is dirt cheap for Americans. So the manufacturing jobs bleed out of the U.S. But if you devalue the dollar by 30%...
suddenly, the math flips entirely. U.S. exports become highly competitive and cheap for the rest of the world to buy, and foreign imports become prohibitively expensive for Americans.
Which changes corporate behavior.
It forces companies to build factories back inside the United States because importing is no longer economically viable.
A 20 to 40% drop in purchasing power just to reindustrialize the country. And again, this isn't something that requires a dramatic press release.
Yep.
Move 1 and Move 2 do the heavy lifting in the background. You promise 2%, you run at 4%, you mandate that 140 massive tech companies buy your debt, and you just let the dollar slowly bleed out.
But that silent bleed creates a brutal, unavoidable divide in the economy.
Oh, definitely.
The world basically splits into two camps. On one side, you have the savers, people holding cash, living on fixed salaries, or sitting in low-yield checking accounts.
The everyday person, basically.
Yeah. They're the ones paying the silent tax. Their melting purchasing power is quietly funding the debt reduction.
Wow.
And on the other side, you have the asset holders.
That brings us to how we're navigating the board today. Because if we're living in a reality where holding cash guarantees a 4% loss of purchasing power every year, the immediate question is, where is the escape hatch?
Where does the capital go?
Right. Where does the capital flow? Let's walk through the exact levels we're watching across different asset classes, starting with the most vulnerable, which is cash.
The read on cash is straightforward. That emergency fund you have sitting in a checking account right now, keep 3 to 6 months of living expenses there.
That's just basic financial hygiene.
Exactly. You need liquidity for emergencies. But beyond that safety net, you have to realize that idle cash is literally the fuel this machine is designed to drain.
It's intentional.
If real inflation is running at 4%, your cash is mathematically guaranteed to shrink.
So if capital is fleeing cash, the first historical life raft is usually gold.
Gold is historically the cleanest mirror of a falling dollar. As the dollar weakens, gold requires more dollars to purchase.
Right.
And what's fascinating when you look at the volume today is who is doing the buying. It's not retail investors driving this price action.
No, not at all.
Central banks globally have been aggressively buying gold. They see the exact same 3 moves happening that we're talking about, and they are moving their national reserves away from the dollar and into hard assets.
And looking at the numbers on the board right now, front month gold is trading around 4,180.
Yep.
And for context, when we say front month, we're talking about the futures contract for immediate delivery. It's essentially the purest read on the spot price right now.
Exactly.
The exact level we're watching is 4,100. We're watching to see if gold holds above that 4,100 line as structural support. If it holds, the thesis remains intact.
Then you have Bitcoin.
Oh yeah, Bitcoin.
Bitcoin is sitting directly in the crossfire of this entire reset mechanism.
The crossfire is an interesting way to phrase it because on one hand, it's a decentralized hard asset, but on the other hand, it's deeply tied to the stablecoin machine, right?
The exact same stablecoin adoption that feeds Washington's debt machine through the Genius Act also fundamentally pulls massive amounts of capital onto crypto rails.
Right. And when we say crypto rails, we mean the underlying blockchain networks that settle these transactions.
Exactly. The stablecoin boom builds the global infrastructure, and Bitcoin sits at the center of that ecosystem as the pristine reserve asset. Currently, Bitcoin is trading around 62,000.
Yeah, 62,000. And the exact level we're watching here is the 60,000 line. Hold above 60,000, and the technical structure is constructive. Drop below 60,000, and the story goes on pause.
Yeah.
I mean, it's still a risk asset, so if the broader market gets spooked, Bitcoin can drop with everything else before it fully decouples.
You have to respect that 60,000 level. It's a massive psychological marker for the market. But there is another angle here, and I think it's arguably the smartest way to look at the board if you want lower drama.
What's that?
We look at the toll booths.
Ah, the infrastructure plays.
Exactly. Think of it like a newly built multi-lane highway. Washington just passed a law forcing millions of cars, in this case, hundreds of billions of dollars, to drive down this specific road every single day. When yield is legally mandated to flow to the stablecoin issuers, the infrastructure wins regardless of what the token price does.
You don't need to bet on what kind of cars are driving or where they're going.
Nope. You just own the toll booth they all have to pass through. The stablecoin issuers, the payment rails, the custody providers.
That makes total sense.
When a coalition of 140 companies builds a mandatory pipeline, the durable edge is standing beside the forced flow of capital, catching the fees, rather than standing in front of it trying to guess asset prices.
Stand beside the flow, not in front of it.
Exactly.
So what does this all mean for you listening? If we zoom out and look at the whole board, this silent reset isn't a theory about the future.
No, it's happening right now.
It's a machine that is currently running in the background of the economy. It is built on a 2% public promise covering up a 4% reality. It is fueled by 140 of the biggest companies on Earth acting as a legally captive buyer for U.S. debt.
Exactly.
And it results in a slowly, purposefully bleeding dollar to shrink $40 trillion of obligations.
And you are standing on one side of that divide, whether you actively choose to or not. That's the most crucial takeaway from the desk today.
Yep.
The silent tax is working on your idle cash right now.
Yep.
Recognizing that is step one. Step two is watching the data, not the rhetoric.
Exactly. Keep your eyes on the exact levels. The dollar index at 101, gold holding 4,100, Bitcoin maintaining that $60,000 line.
It's about recognizing the landscape you're standing on and adjusting your posture accordingly.
It's an incredible breakdown of a complex system. But as we wrap up today's market brief, I want to leave you with something to chew on, something that goes just a step beyond the numbers we've laid out on the board today.
And this raises an entirely new geopolitical question, one that gets to the very core of this new dynamic.
Let's hear it.
If the United States government's master strategy to manage its $40 trillion debt relies on legally forcing private tech and crypto coalitions to buy its treasuries, who ultimately holds the real leverage over the future of the global economy?
That is the question.
Is it the regulators in Washington writing the laws? Or is it the Silicon Valley companies operating the tool booths?
That is the multi-trillion-dollar question right there. Think about your ice melting on the counter. Keep your eyes on the board. Watch those levels, and we'll see how this plays out.